With just a few hours left before the Federal Reserve delivers its FOMC decision, global markets are entering a highly sensitive phase. You can feel the seriousness building across stocks, commodities, and currencies because expectations have tightened significantly compared to earlier forecasts. This is one of those moments where even small signals can create outsized reactions, and that's exactly why today's market environment deserves close attention. What makes today especially interesting is that before the Fed even speaks, we've already received an important rate decision from a country whose economic structure often closely mirrors the United States. That country is Canada. The Bank of Canada has officially announced that it is holding its policy rate steady at 2.25%, a decision that caught many market participants off guard. In recent years, it has been rare to see Canada and the US move out of sync on monetary policy, which is why this announcement immediately drew global attention. Bank of Canada Governor Tiff Macklem addressed the media shortly after the decision and made it clear that there are no immediate changes to policy direction, monitoring frameworks, or forward guidance. Inflation projections remain largely unchanged, and the central bank does not currently see the need to adjust its stance. While Canada's economy is smaller than that of the United States, it still plays a meaningful role in global market sentiment, especially when comparisons are drawn between North American economies. What stood out in this update was the relatively positive outlook for Canada's first quarter of 2026. Growth data showed modest improvement, pointing to signs of stability rather than contraction. Even fourth quarter 2025 estimates, which were expected to range between 0.05 and 0.15%, came in unchanged. This suggests that while growth is not accelerating aggressively, it is also not deteriorating, a balance that markets tend to interpret cautiously but constructively. Shortly after the Bank of Canada's announcement, we saw an immediate reaction in the commodities market, particularly in gold. Prices moved sharply higher in a short period of time, reflecting how sensitive investors currently are to central bank signals. This kind of move often indicates positioning rather than long-term conviction, but it still matters because it shows where short-term capital is flowing during periods of uncertainty. It's also important to place this decision into a broader global context. Just days ago, the Bank of England also held its rates steady, choosing stability over change. China's most recent monetary policy update, released about a week earlier, showed no meaningful shifts either. When multiple major central banks adopt a wait-and-see approach, markets usually interpret that as a signal that policymakers are cautious and highly data-dependent. As we shift focus to the United States, stock market behavior ahead of the FOMC decision tells an important story. Both the S&P 500 and the Nasdaq were trading modestly higher before the announcement, with the S&P 500 up around 0.19% and the Nasdaq gaining roughly 0.43%. On the surface, this looks bullish, but experienced market participants understand that pre-FOMC price action often reflects short-term positioning rather than long-term direction. When stock markets push higher ahead of major rate decisions, it is usually interpreted as positive sentiment. However, this does not necessarily mean markets are confident about the outcome. In many cases, this kind of movement represents temporary volatility, or what traders often describe as a pre-event rally. These moves can reverse quickly once official statements are released. There is also an important relationship to understand between stocks and commodities. Historically, when equity markets strengthen, commodities can face pressure as capital rotates toward risk assets. These two markets do not always move together, and when they diverge, it often signals uncertainty rather than clarity. Today is a textbook example of that dynamic. Adding another layer to this environment are ongoing geopolitical tensions and political headlines. While rumors about a potential U.S. government shutdown have circulated, with probabilities reportedly as high as 76%, there has been no confirmed development that directly impacts today's FOMC decision. Markets are aware of these risks, but central bank policy is driven primarily by inflation, employment, and economic stability, not political speculation. From a technical perspective, U.S. equity indices have struggled to push convincingly above recent resistance levels. Both the S&P 500 and Nasdaq attempted multiple breakouts but failed to sustain upward momentum. This type of price behavior often suggests that markets are waiting for confirmation, and that confirmation typically comes from the Federal Reserve. Another factor influencing sentiment is activity coming out of China, where reports suggest approval for increased purchases of advanced AI-related chips. This has helped support certain technology stocks and may partially explain why U.S. equities have shown resilience despite broader uncertainty. However, the longer-term implications of these decisions remain unclear. Now, when it comes to market expectations for the Fed itself, probability data paints a very clear picture. Current odds indicate a 99% probability that the Federal Reserve will make no change to interest rates. Only a 1% probability remains for a 25 basis point move, either up or down. Probabilities for larger moves are effectively non-existent. This dramatic shift from earlier expectations highlights how quickly market consensus can change as new information becomes available. Just a day earlier, odds for a rate cut were significantly higher, but as the decision approaches, those expectations have nearly vanished. This is not unusual. Markets tend to converge toward the most likely outcome as uncertainty decreases. However, even when the decision itself is widely expected, the language used by the Fed can still trigger volatility. For newer market participants, days like this are extremely important learning opportunities. FOMC decisions do not just influence interest rates, they shape sentiment across stocks, bonds, commodities, and currencies. Understanding how markets react before, during, and after these announcements is a critical part of building long-term market awareness. As the clock ticks closer to the announcement, volatility should be expected. If rates remain unchanged, markets could still react negatively if the tone of the statement is more cautious than expected. On the other hand, neutral or slightly optimistic language could provide short-term relief. This uncertainty is exactly why disciplined observation matters more than emotional reaction. Before wrapping up, it's important to clearly state that this discussion is for educational and informational purposes only. Nothing shared here should be considered financial or investment advice. Markets are complex, and every individual situation is different. If you want daily, clear, experience-based updates on U.S. markets, central bank decisions, and global financial trends, make sure to subscribe to Insured Finance. Like the video if you found it helpful, and share your thoughts in the comments. Staying informed is the first step toward understanding the market, and we'll continue breaking it all down for you here on Insured Finance.